Good afternoon. Good afternoon. It's Monday, the 14th of April. Thank you for joining us for another edition of Monday Market Picks. My name is Silan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. Markets are catching a breath after the Trump administration's reprieve for electronic shipments out of China. But how long will this last? Trump has already come out to say that this is going to be temporary. So what are the consequences of this on again, off again US tariff policy? That's what we're going to be exploring in today's show. So we're going to be looking at the Singapore banks. I have downgraded their outlook to neutral. So I'm going to talk to you about why that is the case. Then we also have venture where Jarek has make a substantial cut to the target price of around 24%. We'll actually take a closer look at that. Eric Ong joins us to talk about ComfortDelgro and why that's actually a really good place to hide during times like this. And the MAS just eased their policy as well as cut Singapore's GDP forecast as well. We got our economist Brian joining us to take us through that. And finally, we got our chart guy with two fresh trading ideas as well. So without further ado, let's start with the banks. What we have seen in the past 10 days or so is that the US administration going from imposing tariffs, pausing tariffs, canceling some tariffs, and now saying that those cancellations are going to be temporary. So it's actually increasing uncertainty massively around corporate decision making. These Trump decision shocks are raising significant real economy risks as companies pause supply chain shifts to Southeast Asia, as well as pause some of their capex plans as well. So we think that the operating conditions for the Singapore banks are going to have big headwinds going forward, and we've downgraded the sector to a neutral, and we actually downgraded DBS to hold and UOB to hold, and OCBC was already downgraded earlier to a hold. We think tariff pause or not, there will be consequences for Southeast Asia in terms of the speed of supply chains relocating. Remember, this was one of the big things that we're expecting for this region in terms of growth for this year. So that might not happen as fast as what we initially thought. We also expect that corporate and personal distress levels to rise. We are already seeing massive bankruptcies in Singapore. It's at a 20-year high already. And we've had 5 years of pristine credit quality. NPLs have been pretty low, partly due to the fiscal support that the governments gave out after COVID. But budgets for a lot of governments around the region are very, very stretched. So repeating that generosity that we saw back in 2020 will be a lot harder. And also, one of the things that we note is that the credit growth for a lot of the Singapore banks have been in developed markets, particularly the EU and the US. Loans there have gone from 14% of loan book 5 years ago to about 18% now. So if you have recessions hitting these markets, you're going to have some more risks there as well. So I think the reality is we are exiting this Goldilocks period for credit quality. During global financial crisis and the 2000-2001 recession, NPLs actually blew up about 45% in the first year of that crisis. We have only penciled in about 18% NPL growth for 2025 in our own forecast. So higher than COVID, but still nowhere near the GFC levels. We expect credit charges to peak around 39 basis points. Risks for both of these assumptions actually to get worse if things in the macro side get worse. At the same time, we think there could be demand destruction in China as well with all these tariffs. And that's going to have an impact on the bank's North Asia exposure as well. So we think the Trump decisions will make corporates pause. Loan growth assumptions have been cut by about 1.8 to 2.1 percentage points. So we think that loans in Southeast Asia for these banks will grow at about 3.5 to 4.5% for 2025 and 2026. And potential Fed cuts can also have an impact on net interest margins. Plus, think about trading income, insurance income, fee income from wealth management. A lot of those will also be fairly may face downgrades, particularly given the market volatility that we are in. So all this has led to us cutting sector earnings by 12 to 18% for the next 3 years. Plus, one of the big things has been the capital returns policies for these banks. They made some very generous special dividends and higher capital returns, share buybacks and things like that, that they announced back in February. While we think that the 2025 capital returns should be fine, going into 26, 27, you may actually start to see some pullback from these banks as the boards think about capital preservation during times like this. So that's something to worry about. But at the same time, the sector is entering this crisis from a position of strength. They've got more than 100% provision cover. They've got very strong liquidity, some of the highest CET1 ratios that they've ever had. That's why we haven't downgraded the sector to a negative, and we're keeping it at a neutral. From a regional perspective, we think those positive balance sheet aspects will help the sector to still get some flow from safe haven flows from investors. That's why we have holds on these stocks instead of sells. From a relative preference, we like DBS, given their global safe haven status and the lower cost of funding. But from a sector point of view, we prefer to rotate out of the banks, take some weightings off the banks and go towards the REITs like CICT and FCT, who would benefit more from domestic exposure and the potential for rate cuts. Now, with that, let's bring in Brian, our economist. Brian, welcome to the show. Now, MAS is the Sing dollar near this morning. Was this within expectations, and how should we read this?
Hi, Dylan. Thanks for having me. So the MAS slope reduction this morning was actually, yes, it was in line with our expectations, right? We're estimating that the near slope was trimmed by 50 basis points. Do note that this is the second consecutive easing move since January, right? So we estimate that the new slope is 50 basis points per annum. How do we read this decision? Basically, the MAS is reacting to dimming global growth prospects and also the benign core inflation outlook. Basically, MAS, while it recognizes that headwinds are intensifying, but at the same time, it's also taking an incremental approach, right? Because there's still substantial uncertainty, I think, on the global trade front. And we think that's why MAS actually saw less urgency to move immediately to a neutral bias, meaning 0% slope. After all, it still has time to react. It can ease policy further during its July meeting. And monetary policy isn't the only factor supporting the Singapore economy, right? The government has an ample dry powder to quickly roll out more fiscal stimulus in the event of a rapid deterioration in the global economy. The accumulated fiscal surplus by our estimates amounts to about 1.9% of GDP, and this can be tapped on over this financial year without needing to draw anything from past reserves. Yeah, so overall, our base case is for no further MAS easing this year, although we do not rule out a shift to a neutral bias if things really deteriorate substantially, in the second half.
Got it. So at least there's a fiscal stimulus space that the government has, particularly around 1.9% of GDP that they can deploy if things really get bad. So that's a good point to put a pin on. Now, having said that, the MTI did cut their GDP forecast, growth forecast to 0 to 2% from 1 to 3%, what they had before. What were their key concerns, and how is this going to affect our own forecast, Brian?
Yeah, indeed. So, the key concerns, of course, is on the global economic front, right? So basically, they highlighted rising headwinds for global trade from the sweeping tariffs introduced by the US, right? Also the tit for tat series of retaliation, right, from China as well. Basically, these tariff hikes, right, will push up import costs and hit global demand, right, especially in the in terms of import demand in the advanced economies, right, like the US, and also export demand for our region. And Singapore, I think, is very plugged into this global supply chain. We are dependent on the external sector, and also we are a key node in the upstream part of the Asian supply chain, right? At the same time, escalating tariff uncertainty has also hit consumer and business confidence in the major economies. So all in, basically, MTI took into account that these factors will all weigh on production, trade, and investments in Singapore's major trading partners. We are keeping our GDP growth forecast at 2.1% in 2025. So if you notice, that actually is slightly above MTI's new 0% to 2% forecast range. Ultimately, we are penciling a growth slowdown at this juncture, but not a recession. Why so? That's because, well, beyond whatever MTI just described, the uncertainty and the import cost shocks from the global trade war. But at the same time, we note that there are some factors that may cushion the blow. For instance, there's a reprieve for most countries' reciprocal tariffs, at least for the time being, and also a possible diversion of trade and financial flows, given that China is bearing the brunt of the tariff hikes, whereas and in relative terms, I think the tariff hikes are already much more than what the other Asian economies are facing, including that of ASEAN, right? So I think domestically we have some things to be hopeful about as well, right? So falling interest rates, a construction boom, and also more fiscal support will help support growth. Well, do note that we have just lowered our 3-month SORA rate forecast to 2% in end 2025. From 2.3% previously. That will represent a substantial, basically 100 basis points decline between the beginning and end of 2025. So basically monetary conditions continue to ease, and that should provide some cushion to the economy. Yeah.
Got it. That's very helpful, Brad. Thank you for joining us. Okay, so before I move on to the next stock, there's a question from John Tan who's asking, what are some of the early signs that NPLs are growing faster than expected? So I think, John, one of the key things that we are watching out for is unemployment. I think that's one of the key areas. Once you start to see unemployment rising, that has a cascading effect across quite a few sectors. And also that's a sign that corporates are also on stress. So that's a key thing that we're looking at. So also corporate closures is also a data point that we generally look at. And also where interest rates are going. So I mean, if you actually do see interest rates holding up for longer while we are starting to see the stress building in the economy, that's something that we'll be watching out for in terms of overall asset quality as well. I think there's a question from the audience on why there's no interactive URLs when we send out our invites, and that's unfortunately that's a security feature for anti-phishing. So we apologize if there's inconvenience, but that's just how our security features are built in. Now, with that, let me move on to venture. Jarek has cut target price to $9.40 from $12.40. He is worried that when venture negotiates new orders, they will face tariffs, which can bring their margin lower. Under the company's current contract terms, higher costs can be passed on to customers, but the new orders negotiations that will happen over the next few months, even if the present situation of reciprocal tariffs are paused, he thinks that the baseline tariff of 10% will still apply, and that will actually get passed on to them on their contracts. Also, they have about 25% exposure into the US market, where customers may actually look to domestically source. And also, if you do have a global slowdown, that's also going to have an impact in terms of volume. The stock is still not a sell, though. We think there is some downside support from their share buyback program and a 7% dividend yield, but we don't see any upside catalyst until we have better clarity on the trade situation. So we're keeping the stock as a hold as of now. Now, let's stay with Singapore and bring Eric on the line. Eric, you say that Comfort is a good place to hide amidst most of the current tariff issues. But before we discuss that, the LTA recently awarded a new 10-year street tail operator license to GrabCab. Are you worried about increased competition from this? Normally, this is Comfort stuff.
Yeah. Hi, Tilan. So right now, ComfortDelgro is currently the largest taxi operator in Singapore with about 63% of the market share. If you recall, Grab taxi license comes 9 months after it abandoned the proposed purchase of another operator, Transcab, because our anti-competitive commission has previously raised concern that it might create barriers for rival platforms. This time round, we understand that the regulator approved the license because GrabCab intends to grow its taxi fleet organically. Although it don't disclose the targeted fleet size and timeline, there will be a 3-year grace period for the GrabCab to progressively expand its vehicle fleet to meet the minimum requirement of 800 taxis. We also think that GrabCab may need more time to scale up given the challenge of attracting enough drivers, as there's already a tight supply of cabbies in the market. For now, we understand that the ComfortDelgro management is adopting a wait-and-see approach on what kind of rental rates or incentive that GrabCab will offer, as well as how aggressive they are in building a fleet before taking any decision on new measures. But in any case, we note that the street hailing volumes has been on the secular decline and account for only 10 to 11% of total point-to-point trips. So in summary, while we do expect sector competition to increase, we reckon that the actual financial impact might be quite muted.
Got it. And why do you think why do you think ComfortDelgro is a good place to be shielded from all the tariff issues? And what are you expecting for first quarter results?
Yeah, so we like ComfortDelgro for its defensive earnings, given the group domestic exposure in each of the respective markets. They also have relatively inelastic demand despite the risk of any economic slowdown. For its upcoming first quarter 25 results, which are due to be released by mid-May, we expect Comfort to report core net earnings of about 58 million, which implies about 45% year-on-year growth. This is mainly driven by contribution from acquisition of Edison Lee, as well as continued margin improvement in this UK bus contract renewals. And what's more, with its high dividend payout of 80%, ComfortDelgro now offer investors a compelling yield of about 6%. And the group has also recently resumed its share buyback through acquiring 115 shares at $1.37 in the open market. So we still have a buy call on ComfortDelgro with a target price of $1.64.
Got it. So good results to be expected, high dividend yield, as well as a good shielding from the Trump tariffs as well because of the domestic orientation. Thanks, Eric, for that. Let's bring our chart guy, Amirul, online. Amirul, what have you got for us today?
Hi, Tilan. Thanks for having me. So let me share my screen first. So before we get into the recommended stocks, so I think it's good if we just take a look at the S&P 500 first. So if you look at the recent decline, it has actually found strong support at this line over here, which is the 61.8% Fibonacci retracement level. So price is currently on a very rebound mode. And we believe if you look closer at the recent 2 candles over here, so this is what we call a bullish engulfing pattern. So usually this is a sign that there's a further upside potential ahead. So we believe that if there's a subsequent green candle, if it could take above this anchored VWAP from its October 2023 low, this is a sign that buyers are regaining control and the bargain hunting could actually continue. So how about the Straits Times Index or the STI Index? So let's take a look. So if you look at this sharp decline from its March 2025 high, we know that this decline over here might have bottomed out actually, because if we draw a line from here to this line over here, we see that this previous decline has actually found strong support at its uptrend line. And if you draw a Fibonacci retracement level, you could see that the decline has actually bottomed up at the 61.8% Fibonacci retracement level as well, the same as the S&P 500. So obviously it is far from giving a bullish switch confirmation. But then if the index could actually take out this immediate resistance at 3610 to 3620, this is a good sign that the rebound could actually continue. But given the recent gap up from this morning, this momentum seems to be continuing. But bear in mind that this could be a bearish flat formation. So if the price breaks below this uptrend line over here, this could be a good sign that the downtrend could actually continue. So let's take a look at our two recommended stocks. So the first one we have is RAFFLES Medical. We actually made a buy call for discounter. It made a mild decline, but then overall the long-term outlook remained bullish because it is making a new higher low structure from this low here. This is a new higher low structure, and the rebound from last week has confirmed another new higher low structure. And the previous decline also has found strong support at the 61.8% Fibonacci retracement level. So given how the RSI is showing a fresh uptick and the MACD is slowly making a sideways range above the positive territory, so possibly this decline from this March 2025 has ended, and the rebound could actually continue if the price could actually maintain above 50 DAMA. So this recent golden crossover over here is what makes me believe that the long-term outlook is bullish. So as long as price maintains above this orange line, which is the 50 DMA, we believe the bullish outlook from the recent golden cross could actually continue. And last one, my mover of the morning would be OILTEK. So we recently made a sell call for OILTEK, and it already hit our target price 0.895. So if I remove all the drawings over here, we could see that the price has actually re-entered the head and shoulder neckline pattern. So this is the first hit, and this is the second shoulder. So we could see that the price has actually re-entered the head and shoulder neckline pattern. It is also now testing the 21 DMA. And if you look at the DMI, it is about to make a bullish crossover. So if the price could actually close above the 21 DMA, we believe that this rebound mode could actually continue. Given that the RSI also has taken above the support line, momentum is now on the bullish side. So OILTEK is one of the counters we can take a look at if you want to go for bargain hunting. So that's all for me today. Over back to you, Taylor.
Right. Thanks, Amirul, for joining us. Now, very quickly, I just want to highlight our buy on Grab as well. The company has just had their first ever product showcase, and Hussaini came out of it very optimistic on how they plan to use AI applications to increase their customer experience and productivity. This should help them achieve their revenue guidance and their cost guidance as well. We've got 34% upside on the stock, and our newsletter has a lot more detail. So do have a read on his takeaways from there. Let's quickly look at upcoming events. We got GDP already came out today. We've got Aztec results coming out tomorrow. Keppel DC, well, the REIT results season will start. Keppel DC results out on the 17th. Keppel REIT out on the 23rd. We'll be covering all these in detail over the next few weeks. And with that, unfortunately, we are out of time. I just want to say thank you very much for your support as always, and we will see you next week and have a profitable trading week.